Hi, welcome to this extended edition of the Market Alert for Friday, the 22nd of April 2016. So yesterday we saw the market not doing an awful lot because of Carney speaking at 3 p.m. I think it was, sometime around there. And then we saw the market give a sell signal which continued lower, and then a further one later on in the evening session as well. So we've got the first indication of weakness after months of the market moving higher. And in these lofty levels, we see that we have a down day. And of course, true to form, they're trying to bring the market back already, and no doubt probably will succeed. So what can we do to actually measure the actual strength and resilience that's left in this market? Well, we can do this by using a Fibonacci retracement from this high. I'm just drawing there to the low of this bar. And what I've done here is just drawn in an area, if the market comes back today, where it's likely to find some resistance at the 18,081 and 18,112. So keep these in mind today if the market does continue to move back to the upside there. Also notice again, those that are vigilant amongst you, that on a down day, the volume increases. On the up moves, there is fresh air. So again, we can see that there was some genuine selling around yesterday as prices move lower, but then tried to reverse and move to the upside. News-wise today, no high impact news items and absolutely nothing for the afternoon session. So it's going to be interesting to see how the market actually performs. It could be as quiet as a mouse. I'll warn you before we get to 2:30 that possibly Fridays can be quiet anyway. But today there is absolutely nothing. We've got European stuff there, but there's nothing to move the US. They're not even wheeling out a Federal Reserve celebrity either. So it'll be interesting to see how the market does. So just be warned, it could be fairly quiet. Now, looking at the bigger picture, let's just go to Zero Hedge. Brilliant article, if I can find it. April cheers bring May tears, something to keep you up at night. An absolutely brilliant article about what I've been talking about, selling May and go away. And here we've got the convictionless seven-year bull market, because the market's being traded by computers and the Federal Reserve, etc. Anyway, I'm not going to go through all the details in this, but what's interesting are these two charts here, where we can see, now if I didn't tell you this, you'd look at that and think it was the same chart more or less, apart from a few more dips. But one is the S&P from Jan to April 2016, that's the top one, and then January, May to the 19th on 2008. And when you start to look at this, you see exactly an incredible parallel to what we had there as well. And then there's the few of us, the lone voices in the wilderness, talking about probably the negative side. I mean, I'm known amongst friends as the prophet of doom, but it's not the prophet of doom, it's the prophet of realism. And the whole of this Ponzi scheme and the debt and the economy and everything else is not sustainable. It simply isn't sustainable. Plus we've got the clowns, the central banks that have taken us into this mess and created this mess, 100% of their own doing. There's no doubts about that either. And now I've read another article this morning where these complete lunatics have now started to pump the commodity markets to create inflation, to inflate the way out of the debt. Also, Japan are thinking now giving money to citizens to go out and spend to boost their debt-based lunacy, known as the economy as well, just to keep the illusion alive. So this really is heading for a major catastrophe down the line. But coming back to this sell in May and go away, I did a bit of research this morning. I went back on a weekly chart all the way back 10 years, and what was very interesting, all the way back to 2006, if I can just find this, is 2006. Here in May we see the market move lower. In 2007 we see the market trading up through May, because this was just prior to a year before we had the major as what's now known as the Great Recession, and goodness knows why. But we see the market going higher through there. But in 2006, the market went down in May. In 2007, it went sideways to higher. In 2008, the market dropped. In 2009, we see the market again moving up through April and through May. And the reason this happened is because this is when the clowns and lunatics in the central bank started to print money, and thinking they were doing everybody a favour apart from the masses, great favour for their banking friends on Wall Street. They pumped money into the market, so the market moved higher from March. That was the low of the so-called Great Recession. So we see the market then moving higher through 2010, but through 2009, 2010 May, we get the down move. In 2011, we get the down move. In 2012, we get the down move. In 2013, we get the down move in May. In 2014, we sailed through this one, the market moving higher. That was the last throws of the dice for the QE. That's when Bernanke was printing 66 billion a month. And then, of course, Yellen took the training wheels off in October 2014, which is why you see that there. So the QE nonsense came to an end. And then we go through and we see May of last year down. And now we're back to where we were. So tied in with the implied volatility, which I've been talking about as well for the last few weeks, down in the lows. And again, we have to go back to last year. We saw down in the lows, and then we had the down move as well. So my money's on the tiers for May, and also bigger than that, going down the line as well, because of the backdrop of all of the debt and everything else which I've spoken about before, and also the desperation of the central bankers to keep this illusion alive and running as well. So an interesting set of statistics there. Just to summarise, we've got 6 down years out of the 10. We've got 2 that saw it happen a month later in June, 1 sideways and 2 sideways to higher, both of which were when in 2008 when they started, or 2009 when they started printing money in the March, which obviously gave the market momentum to forget the May, because we'd just come off a massive correction in the background through August of 2008. And of course the double test at the bottom in 2009. So that's the reason. So if you add those 2 in, we're probably more like 80% chance, but there were mitigating circumstances there. And then 1 sideways, which you'll always get the one. So you can see how heavily weighted the sell in May, go away theory, well, not necessarily a theory, but statistics show that it is wise to step aside on the upside during the month of May. And given that we've risen from February, and it's more or less vertical as we look at the actual chart there from February, this is the weekly chart, you can see it's more or less vertical, then we could expect to see a major correction in this market. It'll be interesting to see how this pans out, but everything is primed for the market to go down in May. The only thing that will stop it from going down in May is the central bankers wanting to keep the Ponzi scheme alive, and the potential of also printing more QE, or the Japanese handing out money, helicopter drops as it's known to the general public, which they're talking about at the moment, to keep everything going. Right, that's it for today, for this week. I will let you know if anything else happens. Be warned though, no economic data today. They're trying to keep the market on the highs. It could be a very quiet sideways move. But that said, sometimes, we get a situation where there's no economic news, and then it just goes in one direction for the duration of the session, because they're not actually waiting for any news, and then they can use whatever excuse they want to keep things moving in the direction they want to as well. Right, that's it. I will see you in Monday's edition. Have a great weekend. As ever, thanks for your support, also for watching. See you in the next one.